Silicon Valley Bank, ranked among the best banks in America by Forbes magazine, collapsed in just 48 hours. But how did SVB become one of the first large US banks to fail since the 2008 global financial crisis? Let's have a look at the key factors that triggered the collapse of SVB and the spillover effect on the Indian markets. But before that, don't forget to like, share and subscribe to the Money Control channel. Silicon Valley Bank is a bank based in California and does most of the business with technology companies. The bank lends to tech firms and most of its depositors are also from the tech sector, including venture capitalists, HNIs and tech firms. SVB called itself the financial partner for the innovation economy. On March 8th, there was a piece of news which suggested that one of the funds run by leading venture capitalist Peter Thiel has asked to withdraw funds from the bank. This news spread like wildfire. It caused other depositors to withdraw their funds from the bank, creating a bank run-like situation. On the same day, the bank issued a statement and a presentation highlighting that it had sold government bonds to shore up its capital base and was also raising funds from large global investors. The bank assured that there was no concern. But this did not assuage depositors' concerns. On March 10th, 2 days after the news of the first major withdrawal, the bank had collapsed. A mix of factors led to the collapse of Silicon Valley Bank. Since the global financial crisis of 2008, the US Federal Reserve and other central banks have followed an easy monetary policy. This was also a period where we started transitioning to an increasingly digitized economy. This, along with an easy monetary policy, led to a significant boom in technology companies. Tech companies of all sizes found it easy to raise and deploy funds. SVB was a beneficiary of this boom as its business revolved around Silicon Valley and technology companies. The easy monetary policy finally ended with the Russia-Ukraine war. The war led to a surge in inflation across the world, and to battle the rising inflation, central banks started hiking interest rates. The Fed has increased policy rates by 450 basis points in the last 1 year, while hinting at a sharper rate hikes in the future. SVB's depositors included many startups that kept their cash with the bank. The bank invested these deposits in voted securities to gain on yields. The rate hikes by the US Fed over the past years drove up the bond yields, piling up losses for Silicon Valley Bank. This, along with the news of the major withdrawal by a venture capitalist, triggered the collapse. The biggest impact of the collapse can be witnessed among India's startups, especially the ones that were funded by American incubator Y Combinator. About 60% of Y Combinator startups with Indian founders have exposure to the Silicon Valley Bank. Being a YC-backed startup is seen as a stamp of approval. The incubator's investors has backed as many as 217 startups in India, including some of the most valued ones like Meesho, Razorpay and Grow. But the YC backing also comes with a rider. Indian companies have to flip their corporate entities to the US to get funds from the incubator. Once flipped to become the US entity, these startups have to open bank accounts in the US. SVB is the default bank for most YC-backed startups thanks to its relationship with the investors from Silicon Valley. Experts believe that the Indian banking system will weather this storm well. According to the Jefferies report, Indian lenders will pass the acid test of Silicon Valley Bank collapse. The report states that the Indian banks have a strong asset liability management or ALM position, with only a quarter of their deposits lying as investments in securities, both government and private. This gives considerable cushion to the market that accidents such as these collapse of SVB are unlikely to happen in India. In terms of the financial market, experts believe that the impact of the SVB collapse will be muted as India is more of a consumption-oriented economy. But if the financial markets in the West continues to decline and there is a recession, it will impact Indian financial markets and the result in lower growth rates in India.